Hardware suppliers intentionally hoarding half a year of inventory, a software giant firing thousands of middle managers despite record profits, and a massive retailer punished purely for putting more human workers back in its stores.
That is an intense lineup for the May 20th batch. We are looking at Analog Devices, NVIDIA, Intuit, and Target today. The overarching read is that operational growth was undeniably strong, but Wall Street is getting incredibly harsh on the structural reality underneath those numbers.
Right, which brings us to the first big story. Let's call it the physical voltage wall. I think people assume the main AI bottleneck right now is just, getting NVIDIA chips. But Analog Devices showed us today the actual limit is the literal physics of powering them.
Exactly. The power density of these NVIDIA processors is now so extreme that local voltage regulation is breaking down. So ADI went out and bought a company, Empower Semi, strictly to solve that power bottleneck on the actual GPU.
And to prep for the next infrastructure crunch in 2027, ADI is intentionally hoarding 168 days of inventory.
It is an unbelievable commitment, but NVIDIA's core cache engine is so strong, they actually abandoned a classic tech illusion today. They started reporting their massive stock-based compensation expense directly inside their adjusted numbers. No more hiding the real dilution cost.
That is an incredible sign of financial maturity. Although I should say ADI's results were a little less clean. That headline adjusted gross margin they posted relied pretty heavily on a one-time channel repricing event, not just pure organic efficiency.
That is a vital piece of context. Now, while the hardware players are throwing cash at the laws of physics, the consumer side is fighting completely different battles over human capital. The split between Intuit and Target is jarring.
Yeah, it's essentially a zero-tolerance labor trap. Intuit generated record free cash flow, yet they immediately fired 17% of their workforce, and they made it clear this was not some futuristic AI pivot. It was literally just purging middle management bloat.
And then you look at Target. They crushed EPS estimates by that exact same 17% figure, but to pull that off, they intentionally increased their operating spend to put more human concierges and weekend staff back into the physical store aisles to fix shopper friction.
And the market rejected both of them. Wall Street dumped both stocks on the margin fears.
Physical labor is just structurally unpopular with investors right now, regardless of whether you're cutting corporate bloat or fixing retail operations.
It feels like you just cannot win. Speaking of which, Target actually warned that their next quarter is going to look artificially terrible. It overlaps the massive one-off sales spike from last year's Nintendo Switch launch.
Let's keep that optical hurdle in mind before anyone reacts to the headline numbers next time.
For sure. And the individual company episodes in the feed hold the complete call transcripts, unpacking exactly how these physical bottlenecks and labor decisions are reshaping those specific operations.